Hey guys, Felipe here. So as you know, I'm here to keep you up to date with current market news and teachings. In this video, I'm just basically going to be doing a financial vehicle breakdown to give you an idea what options is out there for you in the market. So what I'm going to be talking about is basically the concept of infinite banking, which if you've read this book, Becoming Your Own Banker by R. Nelson Nash, great book, it's in like 92 pages. Basically, the concept is using cash value life insurance as your own bank, right? So you have the ability of being your own bank, whether making withdrawals or loans against yourself to finance things, right? Such as other investments, maybe real estate or whatever kind of investment or thing you want to you basically finance through yourself. Simple concept, just using cash value life insurance. So one of the vehicles in this example that I'm going to be going over is the FFIUL, which is called the Financial Foundation Index Universal Life. So it's an index cash value life insurance product, right? There's many providers that provide these, but in this video, I'm going to be specifically talking about Transamerica because they are the number one in the specific vehicle. There's different kinds of cash value life insurance. There's whole life, which is fixed interest, and there is variable life, right? Variable IULs, which just basically means you are at the risk of the market or you're invested in the market and you have no protection. What index is basically means typically that the insurance company or the provider you choose for your policy provides you with a floor, but on the other hand, they provide you with a cap as well, right? But some people like that because they get a guaranteed floor or a guarantee of no potential loss, of course, as long as the actual institution is solvent, right? Because if the insurance company becomes insolvent, your policy is gone. So that's why having a strong financial institution is very important with these specific policies, right? So I'm going to just jump into it and go over the FFIUL, right? Financial Foundation Index Universal Life provided by Transamerica. They're known for this specific vehicle, which is cash value life insurance, right? Which is basically the concept of infinite banking, becoming your own bank, where you can take loans or withdrawals in a tax advantage way on yourself, right? To finance things or investments. So FFIUL, basically very popular product, has 4 key features: death benefit protection, a growth potential, downside protection because it's indexed, right? Indexed, it provides you a protection floor. You might have heard the term zero is the hero. That is basically where it comes from. And it's tax advantage, right? So it's tax sheltered, kind of like a Roth IRA, right? Tax advantages, which you can never have enough tax advantage dollars, right? So FFIUL may help you, your family replace the loss of income through the life insurance, right? Assist your mortgage, childcare, educational costs. Some people can use it like a 529 college saving for their kids, right? And just basically leave a financial legacy for you, your children, and your grandchildren. So here are some statistics basically of how long a family, how long it would take for them to actually feel, the loss of the breadwinner of the family, right? It's pretty scary in terms of 57% of families basically within 1 year will feel that financially, the loss of the breadwinner of the family, 44% in 6 months or less. And then here it breaks it down into shorter timeframes or longer timeframes. So how your cash value accumulates, basically when you make a payment, it's allocated into one of the indexes that you decide, right? When you first open up the policy, right? Such as basic interest account, which just makes it more like a whole life like vehicle, even though it's not, it's just an option, right? Or you have the option of the S&P 500, which is capped at 12%, right? And that can change because sometimes every now and then they're changing these caps, right? Or the global index, right? Which means that your funds are allocated in the Euro Stock 50, the Hang Seng, which is the Chinese index, and the S&P 500, which is the top 500 companies in the US, right? So that's basically the options in terms of where it can be allocated. And this is the breakdown of those allocations in the case that someone decides to choose the global index account, right? So what that would mean is basically 50% of the allocations will go to the S&P 500 or the Euro Stock 50, whichever performs better for that time period, right? Which is in this case segments, and I'll kind of explain that in a little bit what that means. 30% in the case of whether it depends on if the S&P perform better or the stock or the Euro Stock 50 perform better. In the case that, for example, the S&P 500 perform better, 50% gets allocated to the S&P 500, 30% will get allocated to the Euro Stock 50, and vice versa, right? And then the other 20% gets allocated into the Hang Seng Index, which is the Chinese economy, right? Or the Chinese index, right? Which has basically over the last couple of years crashed, right? If you look at the actual Hang Seng Index on the chart, it has performed really bad over the last couple of years, which might create opportunity in terms of, hey, buy low, right? And right now the market for the Hang Seng is low, right? So that is pretty much where the funds are allocated into. And here they just go into the concept of the floor, right? They give basically the notion of, hey, if you make an investment and you lose 10%, for you to break even, you would have to gain 11%. If you have an investment and you lose 50%, for you to break even, you would have to make 100%, right? So that just gives you an idea that, you know, like Warren Buffett says, rule number one, don't lose money. Rule number two, don't forget rule number one, because it's a lot harder to make up your losses when you got to come back from them, right? Because most of the time you have to make up more than what you lost just to break even. So here's how this works in terms of caps and floors. So basically, the global index, which is allocated S&P, Euro Stock 50, and Hang Seng, has a cap of 13% and a floor of 0.75. So when decides to choose just allocations to the S&P 500, they will be capped at 12%, but they would have the same floor, right? 0.75%. What that means is, example, S&P, for example, during a segment, does 18%, right? That means the account for that segment will grow to its cap, 12%. And then in Transamerica would keep the difference, right? I said 18%, so that would be what, 16%, right? 6% Transamerica would keep, right? So the cap is 12, market performed 18% for that year or that segment, the S&P did. Transamerica keeps 6%, they credit the account 12%. However, if the market did negative, the account's credited 0.75% because there's a floor, right? The basic interest account is just basically no matter what, it's credited 2%. So here it just breaks down to give some examples of how that would look, right? I'm not going to go into that, but you can kind of see it there. All right, how are the segments or accredited interests calculated, right? So it's basically annual point-to-point strategy. The FFIUL index account options use annual point-to-point strategy that compares the start and end value, right, of their respective index over a 1-year period to determine the percentage of change in the index. If the result is positive, your account value may be credited with excess index interest. If the result is negative, your account value is protected by the floor, which is 0.75%, right? Excess index interest calculation segments are components of the index account options. to which premiums and or transfers of policy value are allocated, right? There are up to 12 segments. So every month, a contribution or a premium for the policy is paid. Basically, that creates a segment, right? So each month has its own segment, which ends at the same month of the next year, right? So there's 12 segments, right? Which begin on a monthly policy date, and each segment lasts for 12 months, index account segment period. The value of the index account options is the sum of its segment values and the amount pending application to that segment. At the end of each index account segment period, Transamerica determines whether any excess index interest earnings above the guaranteed minimum rate will be credited for that segment period just ended. So here is basically how that kind of looks. The index change percentage is determined by calculating the index value of the segment end date, subtracting the index value on the segment start date, and dividing by index values of the segment start date, right? So for example, let's say the index value on the segment end date. So someone made a contribution January of 2024. In January 2025, that would be the segment end, right? So in this hypothetical example, in that segment end date, the S&P 500 is $4,400, right? At the start of that segment date, which is January 2024, the S&P was $4,000. This is just hypothetical, right? So now we're going to divide the index value on the segment start date by basically, and that's going to give us the index percentage change. So 10% excess index interest would be credited for that segment, right? Because it increased $400 during that time period, which is 10% of 4,000, right? So 10% is credited to the account value. So that's how the segments basically work. It's tax advantage vehicle, basically proceeds passed to your beneficiary free of federal income taxation. So life insurance is not factored into estate at the end of the life, right? Tax deferred earnings. So life insurance contracts meet special IRS requirements that allow amount credited to the policy value to accumulate on a tax deferred basis. Taxes are deferred until the policy is surrendered, lapse, or when certain distributions occur. So these are taxable events to be aware of. If the policy lapse creates a taxable event that now allows the IRS to tax the funds within the account. So those are some things to be aware of, right? Transfers among accounts inside a policy are on a tax-free basis. And initially for the first couple of years of the policy, there is a charge for loans. So basically this is how it works, right? The policy loan interest rates on FFIUL are generally lower than the loans rates charged by banks. An amount equal to the policy loan would be credited with a minimum guarantee annual interest rate of 2%. An annual interest rate will be charged as followed, right? So for the first 1 through 10 years, the interest rate charged on loans are 2.75%, right? However, Transamerica credits you a 2%. So in this case, that loan for the first 10 years is charged a 0.75%, right? Interest rate. From the 11th year onward, basically, it's charged at 2% interest rate. But in this case, the insurance company credits 2%. It's basically a wash loan, right? So it's in that case, a 0% loan. So this is where the whole infinite banking comes in, right? Utilize your policy as if it were a bank where you can take loans from, typically at super low rates, or in the case that you've had one of these policies for a long time, at a no interest rate, right? And then you're able to finance your investments or finance whatever it is you're attempting to purchase, right? So that's kind of how the loans work. Pretty much. So you can add additional riders and stuff to these, such as terminal illness, critical illness, and so forth. Where if someone gets, terminal illness or critically ill, and is diagnosed by a physician, they can access their life insurance while alive, right? Cool thing about these two, additionally to all this stuff, which I'm not going to bore you with, is that there's this thing called basically the deferred plan, where if someone's 1099 business owner, they can write off their premiums, their target premium on the policy when they get an illustration, right, at the end of the year as a distribution towards their retirement. So they have some pretty interesting, cool additional things to these. But yeah, that's kind of how this vehicle works, is cash value life insurance, which is based off of the book I shared with you, Becoming Your Own Banker. Great book. If you haven't read it, it's about 92 pages long, not too bad, pretty short book, but it goes into the concept of infinite banking, right? And what is infinite banking? It's basically utilizing a cash value life insurance policy as a bank, right? Where you can finance, take loans, and purchase investments or whatever purchases someone decides to make. Instead of using a bank, they use their policy, right? So that's about it. You guys for watching and listening. If I shared any value with you, please feel free to like, subscribe, share a comment. If you have any questions, we can learn this stuff better together. And that's it for now. I'll see you guys on the next one. Have a good one.